If you held the Magnificent Seven stocks through 2025, you learned a hard lesson. They are no longer a single trade. The days of buying all seven and watching them go up together are over. In 2025, we saw a massive split. Nvidia and Alphabet soared, while others dead-moneyed or even trailed the S&P 500. So if you want to make money in 2026, you have to be selective. But how do you choose? I'm not relying on hype, and I'm not relying on Wall Street price targets. To find out who is actually worth your money, I ran all 7 companies through my strict 3-pillar Analyst Verification Test. Here is the rubric. To get a passing grade, a stock must pass 3 specific financial hurdles. Pillar 1 is growth. Is their 3-year CAGR still above 10%? Are they actually growing? Pillar 2 is the truth. Is their free cash flow margin above 10%? Are the profits real, or is it just accounting magic? Pillar 3 is efficiency. Is their return on invested capital, or ROIC, above 15%? Are they burning your money or multiplying it? I've graded them all. Only 4 companies earned an A. 1 company failed almost every single test. We are counting them down from the worst to the best. Let's jump into rank number 7. If you are new to this channel, welcome. This is Joe from the Investment Diary. I have been investing for the past more than 5 years and have consistently beat the market in the past 3 years with more than 20% annualized returns. I have traded Forex, commodities, stocks, and options, made painful mistakes and punished by the market, and I would like to share my lessons and journey of investing with you in this channel so we can both supercharge our investments. Support me by tapping on the like and subscribe buttons. Coming in at last place, rank number 7, and I know the comments section is going to hate me for this, is Tesla. Now, before you type "you just don't get it," let's look at the actual numbers. In this verification test, Tesla is the only company that strictly fails all 3 of our pillars. It is no longer trading on the fundamentals of today. It is trading entirely on a promise for tomorrow. First, Pillar 1, growth. For years, the Tesla story was simple. 50% annual growth forever. But 2025 killed that narrative. We saw automotive sales flatten, and in key markets like China and Europe, they actually turned negative in some quarters. Why? Because the competition finally arrived. BYD isn't just coming, they are here, and they are winning on price and variety. The days of Tesla selling every car they can make with zero advertising are over. They are now a mature automaker fighting for market share in a saturated market. Next, Pillar 2, free cash flow. This is where the tech company argument falls apart. We check for a 10% free cash flow margin. Tesla is hovering around 2 to 3%. Think about that. For every dollar Tesla brings in, they only keep 2 or 3 cents as free cash. Why? Because unlike Microsoft or Meta, who sell high-margin software, Tesla has to build massive physical factories. And on top of that, they are spending billions on AI clusters and the Dojo supercomputer. They are trying to fund a massive AI startup inside a capital-intensive car company. That burns cash. A lot of it. Finally, Pillar 3, efficiency, ROIC. 2 years ago, Tesla had industry-leading auto margins, but to fight off BYD and keep the factories running, Musk had to slash prices. Those price cuts decimated their efficiency. Their return on invested capital has collapsed as margins compressed. They are moving more metal, but making less money on each unit. That is the definition of declining efficiency. Look, I want to be clear. I understand the bull case. You don't buy Tesla for the Model Y. You buy it because you believe that in 2027, the robotaxi fleet will turn on and pure profit will rain from the sky. You buy it because you think Optimus will replace human labor. If Elon is right, this stock is cheap. If he pulls that off, this degrade doesn't matter and the stock 10x's. But that is now a gamble, not an investment. Alphabet, Microsoft, and Nvidia are printing money right now. Tesla is burning money right now to build a future that hasn't happened yet. That makes it a story stock. It has the highest risk, the widest range of outcomes, and the weakest fundamentals of the entire group. And that is why for 2026, it is ranked last. Next up at rank number 6 is Amazon. Amazon gets a grade B. Now, this might surprise some of you because Amazon is a beast. It dominates e-commerce, it dominates the cloud, and it's building a massive advertising business. But in our rigorous verification test, it strictly fails one of our most important pillars. It is a flawed giant. Let's look at the good news first. Pillar 1, growth. This is an easy pass. The engine is roaring. AWS is re-accelerating as companies rush to train AI models on Amazon's custom Trainium chips. And don't forget the advertising business. It's quietly growing at 22%, generating billions by letting brands pay to be at the top of your search results. If you only looked at growth, Amazon looks like an A. But then we get to Pillar 2, the truth, free cash flow margin. This is where Amazon falls flat. We require a 10% margin to pass. Amazon typically hovers in the single digits, around 4 to 6%. Why? Because Amazon is effectively running a charity for consumers on the retail side. Shipping packages in one day? Expensive. Maintaining thousands of warehouses? Expensive. Managing millions of returns? Extremely expensive. This low-margin retail empire swallows up a huge chunk of the cash that AWS prints. Compare this to Microsoft. For every dollar Microsoft brings in, they keep 37 cents. For every dollar Amazon brings in, they keep maybe 5 cents. They make up for it with massive volume, but from a pure efficiency standpoint, they are working way harder for every dollar of profit than their tech peers. Amazon is an empire, no doubt. It is a cash flow machine in absolute dollars. They will generate billions this year, but it is inefficient. When you buy Amazon, you aren't just buying a tech stock, you're buying a massive logistics company with tech margins attached to it. That drags down their score. It's a solid hold, but until they can prove they can crack that 10% margin barrier, they are stuck at a B. At rank number 5, we have Apple. Apple also gets a grade B, but for the exact opposite reason of Amazon. Where Amazon is high growth, low margin, Apple is the low growth, high margin king. Let's start with the good news. Pillar 2, free cash flow. This is an easy pass. Apple runs with margins of 25% to 28%. They are the gold standard for turning metal and glass into pure profit. They don't just make money, they hoard it. Pillar 3, efficiency. Another easy pass. Why? Because of the buybacks. In the last year alone, Apple spent over $100 billion repurchasing its own shares. They're essentially eating themselves to make your shares worth more. It is an infinite money glitch for earnings per share. But then we hit a wall. Pillar 1, growth. This is a fail. The days of 20% iPhone growth are dead. The reality in 2026 is that the iPhone is a mature utility, like your refrigerator or your microwave. You don't replace it every year anymore. You replace it every 3 or 4 years. Even with the iPhone 17 and Apple Intelligence, top-line revenue growth is stuck in the single digits, hovering around 5 to 6%. Apple Intelligence is a great feature, but it's a retention tool to keep you from switching to Android. It's not bringing in millions of net new users. Apple isn't a growth stock anymore. It is a value stock disguised as big tech. You don't buy Apple because you expect it to double in 12 months like Nvidia. You buy it because it's the savings account of the Magnificent Seven. It's safe, it pays a dividend, and they will buy back your stock forever. But if you want aggressive growth, this is dead money. That's why it's stuck at rank 5. Now we enter the A-grade tier. These are the companies that didn't just survive our stress test, they crushed it. These are the stocks you build a portfolio around. At rank number 4, Meta. Meta gets a grade A. If you held this stock 3 years ago, you remember the pain. The market hated the metaverse pivot. They said Facebook was dead. But Meta is the comeback kid of the Magnificent Seven. They pulled off one of the greatest corporate turnarounds in tech history. Pillar 1, growth. Pass. Remember when Apple changed its privacy settings and destroyed Meta's ad targeting? Well, AI fixed it. Meta didn't just sit there, they built Advantage Plus. This is an AI engine that automates ad creative and targeting better than any human could. It revived their ad pricing power and brought revenue growth back to double digits. They are also finally monetizing WhatsApp through business messaging, a dormant volcano of revenue that is just starting to erupt. Pillar 2. Free cash flow margin. Pass. Zuckerberg's year of efficiency wasn't just a one-time slogan, it became the company culture. They cut middle management, they slashed the bloat, and crucially, in 2025, they finally cut the burn at Reality Labs by 30%. The result? Margins are sitting pretty at around 35%. They are converting 1/3 of every revenue dollar into pure cash. That is elite territory. Pillar 3. Efficiency. Pass. Unlike Amazon or Tesla, Meta's core business, Facebook and Instagram, is incredibly asset-light. They don't need to build factories or ship boxes. They just write code and sell pixels. And on the hardware side, they stopped trying to force VR headsets on us and found a hit with the Ray-Ban smart glasses. They finally realized that wearable AI needs to look cool to work. Zuckerberg proved he can listen to the market. He pivoted from a metaverse-first company to an AI and efficiency-first company, and the stock is rewarding us for it. It's profitable, it's growing, and it's disciplined. It is a solid A. At rank number 3, we have the main character of the stock market, NVIDIA. NVIDIA gets a grade A. Honestly, if we were grading purely on numbers, this would be an A+++. The financials here are in a league of their own. They aren't just beating the test, they are breaking the curve. Let's look at the absurdity of these numbers. Pillar 1. Growth. Pass. Revenue is up 62% year over year. For a company worth trillions of dollars, that is mathematically impossible, yet they are knowing it. Pillar 2. Free cash flow margin. Pass. This is the part that shouldn't be possible. Usually, hardware is a low-margin business. You build a chip, you sell it for a small markup. NVIDIA is different. They have gross margins of 70% and operating margins of 58%. They are selling hardware, but they are making software-level profits. They have a monopoly, and they have pricing power that we haven't seen since the iPhone launched. Pillar 3. Efficiency. Pass. NVIDIA is a fabless designer. That means they design the chips in California, but TSMC builds them in Taiwan. NVIDIA doesn't have to spend $20 billion building a foundry, they just spend money on R&D. That makes their return on invested capital, ROIC, absolutely elite. So, if it's the perfect company, why is it ranked number 3? Why isn't it number 1? It's the risk factor, specifically customer concentration risk. In their latest filings, NVIDIA revealed that 36% of their revenue comes from just 3 customers. We know who they are: Microsoft, Meta, and Alphabet. Think about how fragile that is. NVIDIA is effectively a derivative trade on the CapEx budgets of 3 other CEOs. If Satya Nadella or Mark Zuckerberg wakes up tomorrow and decides to cut AI spending by 10%, NVIDIA's stock doesn't just dip, it crashes 20% overnight. NVIDIA passes every financial test with flying colors, but that structural fragility, that dependency on a tiny group of whales, keeps it out of the top spot. It is a grade A, but handle with care. Rank number 2 is the defensive king of the group, Microsoft. Microsoft gets a grade A. If NVIDIA is the flashy sports car, Microsoft is the tank. It might not go 0 to 60 in 2 seconds, but you cannot destroy it. Let's look at the financials that make this the safest bet in tech. Pillar 1 is revenue quality. We want to see double-digit organic growth. With 17% top-line growth and Azure accelerating at 39%, this is an easy pass. The demand is real. Pillar 2 is where the thesis breaks. We'll look for a free cash flow margin of at least 10%. Pillar 3 is return on invested capital, ROIC. Historically, Microsoft sits at 30% plus. But when you increase your capital base by $37 billion in a single quarter, your ROIC mathematically drops until those assets generate profit. We are marking this as a watch. The efficiency is degrading in the short term. But it is bulletproof. Its products span Office, cloud, security, gaming, and coding. You cannot fire Microsoft without shutting down your company. That's why it's ranked number 2. And finally, the winner. The stock that ranks number 1 for 2026 is Alphabet. Alphabet gets the only perfect score, A+ in my book. Now, I know what you're thinking. 2 years ago, people said Google was dead. They said ChatGPT was the Google killer. They were wrong. In 2026, Alphabet has proven it is not just surviving the AI shift, it is dominating it. Here is why it wins the gold medal. Growth is actually re-accelerating. For years, Google Cloud was a distant third behind Amazon and Microsoft, but in 2025, Google Cloud grew at 34%. It is growing faster than its rivals because it is the best place to train AI models. And search? It didn't die, it evolved. AI overviews didn't kill ad revenue, they made search better. The core business is still a monopoly that prints money. The scale of money this company makes is hard to comprehend. They ended 2025 posting $35 billion in net income in a single quarter. They have a fortress balance sheet that allows them to return capital to shareholders while funding the most expensive R&D projects on Earth. They are the financial equivalent of a superpower nation. This is the reason Alphabet beats Microsoft and Meta for the top spot. Microsoft and Meta are addicted to NVIDIA chips. They have to pay the NVIDIA tax, buying H100s at huge markups. Google is NVIDIA's competitor. They have been building their own custom chips, the TPUs, for over a decade. They train Gemini on their own silicon. They run Waymo on their own silicon. They control the entire stack, from the chip to the cloud to the model to the app. That vertical integration means their costs are lower and their margins are higher than anyone else. Alphabet gives you the safety of a utility, search, the hyper-growth of a startup, cloud, and the moonshot potential of the real world, Waymo. It is cheaper than Microsoft, it is safer than NVIDIA, and it is growing faster than Apple. It is the cleanest, strongest, most complete buy on the board for 2026. Alphabet is our rank number 1. So, there you have it. The verification is complete. We have Tesla in the speculative D tier, Amazon and Apple in the flawed B tier, and Meta, NVIDIA, Microsoft, and our winner, Alphabet, in the A tier. Now, one crucial disclaimer before you roast me in the comments. I am ranking the fundamental quality of the business, not predicting the stock price. There is a big difference. A D-tier fundamental business can still double in price if the hype cycle catches fire, and an A-tier business can drop if the broader market crashes. My goal here was to show you who has the strongest engine under the hood, but remember, the market decides how fast the car goes. With that said, do you agree with putting Tesla last? Or do you think the robo-taxi future makes my verification test irrelevant? Let me know in the comments below. Thanks for watching, and I'll see you in the next analysis. If you enjoy content like this, make sure to like and subscribe, as I will be posting more videos about investing this year. That's it for today's video. See you in my next diary.